Very good. So thank you very much. Good afternoon, ladies and gentlemen, distinguished guests, colleagues and friends. It's a great pleasure to welcome you all to the Bundesbank and the Bundesbank's Training Center, and particularly to this year's CEPR Finance Workshop. Let me start with a little brief personal note. We're at the Research Center of the Bundesbank. We're very keen on joining the CEPR Household Finance Network for quite a while, and we really worked hard to become part of this outstanding community of researchers and policymakers. However, at times, timing matters, and we were unfortunately slightly late to the show. Denmark's National Bank joined just before we did, which gave them the privilege of hosting the last year's workshop. And so we had to wait one more year until it was our turn. And we felt at that point slightly disappointed, to be honest. But in hindsight, this extra year has turned out to be a real advantage, especially in light of the topic of today's panel discussion: financial advice in the era of artificial intelligence. If we had held this discussion a year ago, the conversation would likely have to be quite speculative. Artificial intelligence was already, of course, a prominent topic at that time, but its concrete implications for household finance in general and for the retail banking in particular were still emerging. Over the last year, however, the pace of change has been quite remarkable. What was until recently largely a promise or a prototype has quickly become part of everyday financial services. And let me briefly highlight just a few examples that illustrate probably how AI rapidly has changed or has entered retail banking. Many banks, for instance, have now introduced AI-powered financial assistants embedded in their mobile apps. These tools analyze transactions, transaction data at real time, categorize spending, and provide personal budgeting advice, for instance, even in natural language. We have seen the rollout of generative AI chatbots for customer interaction. These systems can explain financial products, simulate scenarios, and guide customers through complex financial decisions, such as mortgage choices and other important decisions that they have to make. Some institutions are experimenting with automated investment advice enhanced by AI, where robo-advisors dynamically adjust portfolios based not only on market developments, as we already had earlier, but nowadays also in fear preferences from households' past transactions and their behavioral patterns. AI is increasingly used to deliver proactive financial guidance, for example, alerting households to potential liquidity shortfalls and therefore suggesting refinancing options and identifying opportunities to optimize savings. Importantly, these developments are not confined to fintech firms and are therefore not only available to geeks. They are provided by European retail banks and incorporated into their retail offerings to everyday customers. But these developments, of course, raise fundamental questions. How does AI change the nature of financial advice? Will it democratize access to high-quality guidance? Or will it create new risks and new biases? What happens to trust when advice is generated by algorithms rather than humans? From a household finance perspective, these are obviously highly relevant questions. Financial decisions, savings, borrowings, and investments are complex and often made under extreme uncertainty, but they become ever more important in an aging society. So access to good advice can therefore significantly improve outcome, but AI-based advice can also be misunderstood and even misaligned with customers' interests. So AI therefore has the potential to be scaled in unprecedented ways, but scaling also implies that benefits and risks might be amplified. By having to wait one more year, we are now in a much better position to discuss these issues in a concrete and informed way. We are no longer talking about what AI might do. We are able to observe what AI actually does to real products used by real households. So I'm therefore very fortunate to looking forward to a very inspiring panel discussion. We have an excellent group of speakers who bring different perspectives from academia, policy, and practice. So I'm confident that we will have a very lively discussion, shedding light on the opportunity, but also on the challenges that lie ahead. With that, let me thank you all again for coming here and joining us. I'm looking forward to an engaging and thought-provoking session, and I would like to invite the speakers to join me on stage. Thank you. All right, so before we probably dive into the hopefully very lively discussion, let me quickly introduce our panelists very briefly, even though they probably don't need any introduction for this audience. To my left is Fritzi Köhler-Geib. She's since 2024 board member of the Deutsche Bundesbank. Most importantly, she's responsible, of course, for the research center. But besides that, she is also responsible for data and statistics, risk controlling, and IT. And in that capacity, she is also responsible for the Bundesbank's AI strategy, which is something that will certainly be of great interest, probably also for our further discussion today. Next, we have Christine Laudenbach. She is since 2022 professor of finance at Goethe and director of the household finance department of the SAFE Institute. She has extensively worked on behavioral economics, in particular on how biases affect household financial decisions and how financial advice might help to mitigate them. I hope that's a fair summary. Then we have Peter Oertmann. He is a founder of several financial services firms and former CEO of Vesco. I hope that was a proper pronunciation, yeah. And at this point, he is an active chair of the advisory board of Ultramarine, a tech firm specialized in development and application of AI in asset management. That certainly brings an important insight also for our discussion today. In addition, he's also an honorary professor at Technical University of Munich. Further to the right, we have Michael Haliassos, who certainly doesn't need a particular introduction.
They know me.
They know you. So then let me just point out that you are, as my understanding, the founding father of this network, so we're very happy to have you with us, and I'll save the rest in terms of timing. I think you're known very well. All right, with that being said, the agenda that we have given ourselves is to have for each panelist basically the opportunity for an introductory statement. Then we will move into an interaction on stage, but finally we will certainly also have the opportunity to open the discussion to the floor for questions that you might have. So be prepared. And with that, I would suggest to move on, maybe for Fritzi to give her introductory comments. And so where do you see the chances and risks of AI in household finance? What are the potential monetary policy, financial stability concerns as a central banker if we see that AI is becoming increasingly important?
Yeah, thank you very much for the opportunity to be here. It's a great pleasure to have you all here and the opportunity to add my 2 cents on this topic. I have to admit, I have the impression I'm thinking, talking, discussing artificial intelligence all the time these days. And that may have to do with the fact that I'm, among other things, also responsible for IT at the Bundesbank, but it could also be that really AI does impact quite a few dimensions of the economy and the society. Now, yesterday I was at an event which was called Disrupted Age, and that was also about AI. Before that, I was discussing AI and its impact on cybersecurity. So I'm very pleased that today we're delving into household finance and AI, and I'd like to share 3 considerations in that context. Now, when thinking about households, and that will be the first consideration, I think it's important that we take note of the fact that households are starting to use artificial intelligence in their financial decisions. Now, we have the private households and their finances survey, and last year's edition showed that around 40% of households do use artificial intelligence either professionally or privately, and of those who use it privately, 20% use it also for financial matters. This number is lower in Germany than what we see in the UK or the US, where more than half of adult population is using artificial intelligence for financial advice. And of course, the question then is, okay, why do people use it so heavily? And well, one answer is that it's very easily available, and it is without any, let's say, immediately visible costs. And so Tim De Silva will show tomorrow that this advice and that access to financial advice may particularly benefit households that didn't have access to financial guidance before. So that could be a very positive impact. At the same time, of course, there are questions about privacy and the use of data. And I always have to think about a conversation with a financial advisor who basically uses BERT to gather information about companies. And I still see the shock in his eyes when he reported on his feelings when he had asked BERT about what BERT knew about him, the advisor, and then even worse, the question of what BERT knew about himself that he, the advisor, didn't know. So the second consideration is from a macro perspective. No? And when we aggregate those findings on the household level, what does this imply? You alluded to monetary policy, and there are those papers that indicate that the transmission of monetary policy may even be stronger with an increasing use of artificial intelligence. And there is the paper, for example, by D'Acunto and Rossi from 2023, who show that the lack of awareness of individuals of policies basically weakens monetary policy transmission, because people may not even act on signals. And in that sense, they then make the argument that artificial intelligence available broadly and at low cost could really have a positive impact. It is true that when we look from this household perspective, the findings with regards to financial stability are unclear. Or let's say there are different findings in this regard. What is pretty clear is the research, though, from a rather macro perspective on financial stability. And there we see that the use of artificial intelligence in trading actually may have quite relevant impacts on financial stability. Our colleague Kartik Anand from the Research Center has this paper that shows that if you have Q-learning trained investors, they tend to coordinate more on redemption of capital from funds, while if you have reasoning-able models that underlie traders, this is less the case, because in that case, it depends on whether those traders choose optimistic or pessimistic beliefs. But it means altogether that we need to know what type of models are in the system, and that may have relevant implications for financial stability altogether. And that already leads me to the third point, which is, as policymakers or central bankers, these are all elements that make clear that we really have to monitor these developments very closely, because they may have quite relevant implications. And I think in Europe we have a good governance basis through, for example, the Artificial Intelligence Act. It's also true that we are in a world that is very competitive, so that certainly also is relevant when we think about the further development of artificial intelligence and how it may be used globally. And also in Bundesbank, you already alluded to the artificial intelligence strategy, where we set a frame how our colleagues, how we all can use artificial intelligence in a way that we are innovative and can also experiment with it. The idea is to really empower the use of it. And not last, we are expanding our research on the future of finance, including the impact of artificial intelligence on financial markets, for example. And I leave it here, looking forward to the further discussion.
Thank you very much, Fritzi. Maybe we could move on to Christine Laudenbach. So where do you see the potential role of AI improving households' financial decision-making? Will AI help mitigate biases, or will it rather aggravate them? I guess you have prepared something for us.
Yes. Where do I have
maybe it might be helpful to go there.
Do you see the slide? Okay, I see the slides. Okay, so I will talk a bit about the question whether AI can close the advice gap, given that I work on discrimination and especially on gender economics. I made this as a focus here. So, yeah. Can you... So the... okay. So let me shortly talk about the advice gap. So there is the differential treatment across many customer groups is well documented, and I want to, because financial advice is a credence good, so advisors are incentivized by kickbacks. We all know that there's a large literature on that, and I want to make an example about. So my example today is about gender discrimination. So from the literature, we know, for example, that female entrepreneurs are charged higher interest rates. We know that female applicants in the consumer credit market are more likely to require a guarantor, and that trained auditors are more likely to receive under-diversification advice when they are female. And I want to highlight a paper that I did together with Tabea Bucher-Köhnen and Johannes Köhn and Andreas Hacketal, where we looked at advisory meetings and at the protocols. And what we found there is that there is gender discrimination in financial advice. And what you see in the upper right graph is that is one regression where we looked at rebates on funds. So you know that there are fund fees when you buy an investment fund. And the question here was whether women get a different degree of rebates. And we see that female clients are less likely to get a rebate. They are also more likely to get advised higher TER funds. And this is not only true for females, but you also see a differential treatment for wealthier clients, for clients with an academic degree, and for clients with a foreign citizenship. And when we look at why this is the case, we can show that advisors perceive these groups to be more insecure in financial decisions, and that they also think that they are less likely to negotiate. And when you look at the mechanism, what we see is that gender is used as a proxy for price sensitivity, and which leads to self-serving recommendations. And one example here is that women are perceived, as I said, to be more likely to be less price sensitive. And of course you can argue, yeah, but maybe they do ask less often and so on. But what I wanted to show is we did an experiment where we also used AI to generate pictures of fraternal twins. And we used these pictures in one treatment group with profiles for the advisors. And what we saw there is that if the pictures are involved in the profiles of clients, women are more likely to be charged a higher fee. But if we add financial literacy scores from tests that the advisors did themselves to the information, the gender gap goes away, which means that this proxy thing for price sensitivity through financial literacy can be shown here. And why am I telling you all of that if we are now talking about AI today? Because the question is, of course, whether AI is a solution to these kind of problems or questions. And what I want to show you first is a survey that we did last year in 2025, where we asked, for example, this might have changed tremendously because, of course, I think on a weekly basis results would change here. But what you see here is that many people have used it, but not all of them, so like chatbots, right? And you see that, of course, the curve declines with age, but the gender gaps are there. They are also partly large, but not as large maybe as in other dimensions. But when we ask for trust in AI, so would you use AI for the following things, what you see is that for retirement planning or investments, people in the general population do not seem to be too convinced to trust it there, but everyone who tried it, or most of the people who tried it, were very satisfied with it. So we rarely get in a follow-up question the answers that people were not convinced about that it helped them, which means that conditional on trying, they seem to get something out of it in which they more or less trust at least. And so I think Alberto Rossi was already cited, so he has many papers. I'm sure most of you are aware of them about robo-advisors, which is not necessarily all what you can do in the AI domain, but it was, I think, the starting point when you think about advice. And what they show is that the use of robo-advisors increases diversification. It reduces the cost, so people take funds with lower expense ratios. You tame some behavioral biases, so you get you get rid of them, and you have lower cognitive costs when you use those. On the other hand, we have a lot of research which is not necessarily all in the AI domain, but which shows that the human involvement remains critical. So, for example, the adoption of robo-advisors is higher if you, for example, can just call someone if you are not happy or if something happens, and you have the possibility to call someone, even if the person does not give recommendations. It's maybe a service hotline or something, but if this is there, the adoption rates are higher. And what you also see is there was an experiment which was also conducted with also researchers involved from Goethe, where they show that bank clients, it was with a real savings bank and clients, that bank clients are significantly more likely to follow investment recommendations from a human AI hybrid team than from an AI alone. So they wanted to have the human involved, and I myself have a paper which has nothing to do with AI, but there was a two-way communication with a financial institute in the context of delinquencies. It was a phone call versus a written communication, and there you see that that people who were called, even if the information was the same, are more likely to repay, and that the repayment behavior depends on whether they liked the voice of the person who called them. So this shows that it's not an information-driven thing, so it's really the human factor that seems to matter, and you also see this in other domains. So for example, that people like arts, and once they know that it's AI generated, they do not like it as much as before. Also, it's the same is true with music, and there are a lot of studies flowing around with these kind of things. I want to talk about two more things, and then I'm done with my 10 minutes, I think. So the first is AI discriminating? So there's a paper showing that AI recommendations differ between men and women. So this was the prompt. I'm a 40-year-old woman who is looking to invest 50,000 euros over a 5-year horizon. I don't have access to any employer-provided retirement plan, blah, blah, blah. And what you see controlling for a lot of things is that there's a gender bias also in recommendations. And the second thing I want to show you is, does AI reduce biases? And this paper here, it shows that it's good because people had to make an investment decision, and it could be more or less risky. And what you see is that if you get access to a chatbot compared to Google or to nothing, what you see is that people are more likely to participate in the market. So it helps in that dimension. Also, the perceived complexity drops, the confidence increases, so the entry barriers are reduced. I wanted to surprise my co-author with results from our experiment that is currently running, but I got the chatbot results this morning, and even if I'm super fast, next time. So, but on the other hand, what you also see is that you have the risk of a personalized echo chamber. What does it mean? So every time I have a new research idea and I try to discuss this with any kind of chatbot, I have the feeling that I'm the new Nobel laureate, because it always tells me, Christine, this idea is amazing, it's great. So, and this is also what, of course, happens when people ask other questions. So when they tell about their biases in investment decisions, the AI, of course, somehow corrects them, but in a very polite way, and it's very easy to get into this confirmation bias that you ignore the bad things and just read the positive ones. And with this, what you see overall is, at the moment, we need a human in the loop anyways for legal restrictions, but also you see that these hybrid teams are preferred, and that it's at the moment very, very difficult to let's say, replace a human advisor with an AI. You can do this for a lot of knowledge things. So for example, I have a friend who just started investing, and so I got a lot of questions like, when you look at an ETF, what does the distr means or the accum means? So these kind of questions are easily to solve with AI, of course, but you could also Google it beforehand, but it goes faster and you can ask, of course, more if you interact. But I think overall, at the moment, at least, the human element remains vital in the decision-making processes.
Thank you,
That was my answer to your question.
Thanks very much. I think that almost answered all questions that I had on my list. Thanks very much. But maybe we can now move to a more practical perspective. How is it actually applied, implemented in the industry? So, Peter Hartmann,
okay.
Maybe you could allude to that for us?
Yeah, my pleasure. So thanks for inviting me to this conference. I would like to talk a little bit about the transformation in the asset management industry, because this industry is important also for households, because it delivers all the products and the advice. And since I'm working there since 28 years, I think it's natural to talk a little bit about what's going on in the asset management world. Is there a secret? Secret? Okay, can you flip it to the next? Okay, thank you. So, so the question is, where does the industry stand? That's the question, and I would like to share some thoughts on that. First of all, we all believe that there are substantial opportunities, because in financial services and in asset management, it's about processing data. In every part of the process, we have huge amounts of data, and we know that AI is able to elevate data processing on a next level. In terms of decision making, we need to process data consistently, fast, and comprehensively. And we know that AI, by the capacity to get deeper into the data leads to better informed investment decisions. We are able to automate our complex processes to a higher quality, multiplied research productivity. So research is very sophisticated in the production of investment products, and we are able to multiply these capacities significantly in the asset management industry, and we are able to create highly customized investment products. So AI is able to process data. On the other hand, agentic AI models are able to orchestrate entire workflows in research, in product development, also compliance processes, and so on. So the vision is to create something like a agentic AI investment factory. That's definitely the vision. And asset managers have begun to unlock these potentials, but currently the industry is still searching for best practices. And along this process, there is substance and there's also hype. And I would like to look at the state of the industry from an academic point of view. So 10 times, okay. So there's lots of research on the trajectory and the impact of technological shifts on companies and economies for decades. And I would like to highlight two pieces of research. First of all, Carlota Perez studied the trajectory of 5 major technology revolutions and identified 2 main phases. She worked in the wake of Schumpeter, who very early identified the drivers of technological revolutions, and she identified 2 phases. First of all, there's a kind of installation phase. In the installation phase, new technology emerges, capital flows speculatively into narratives, and we have sometimes valuation bubbles. This is the installation phase. The installation phase is followed by the deployment phase. In the deployment phase, we have the penetration of a sector or of the processes with a new technology. So new prosperity can be created, value is added. So installation phase comes first, and then we have this deployment phase. And the second piece of research, I think it's relevant for what's going on in the asset management industry, is a kind of microeconomic perspective on what's going on in the market. So Clayton Christensen, I suppose you're familiar with this researcher and also his work. He studied the microeconomic dynamics of technological transformations, and he documented that the market leaders repeatedly risk missing disruptive innovation because they optimize their successful processes, they invest in their existing clients, which is rational. But in doing this, they become blind to disruptive innovation that enter the market from time to time below their commercial perception threshold. And this is a big problem for the incumbents to engage in disruptive innovation. So the question is, where does the asset management industry stand? So my perception is that we are in a kind of advanced installation phase with some industry-specific characteristics. So some typical symptoms of the installation phase are not observable. So I mentioned Perez identified speculative capital in the installation phase, investing into narratives. This cannot be observed in the asset management industry. There's no wave of AI native market entrance. There's no AI related valuation bubbles in the industry, and we have no speculative growth capital. This is related to the regulation of the industry. So we have regulatory requirements, and they create structural barriers to entry the market and protect the sectors to some extent from speculative exaggeration. Venture capital is practically unavailable for young asset management companies because of all this regulation and the necessity to build trust in order to get into the business. So, but on the other side, we observe developments in the industry that display characteristics typical for the installation phase. So we see that new infrastructures are built, data structures, interfaces, cloud computing capacities are created. There are massive investments in AI strategies everywhere, but in many cases, it's an investment in the narrative rather than in the substance of the use of AI in the industry. We see pilot projects everywhere, but a dedicated integration into the processes, into the core processes, remains the exception. So currently, we only have a very few AI-related fundamental changes of the work processes. So it seems that the organizational and cultural transformation is lagging behind the technical transformation. So finally, the question, are established firms in a trap related to the innovator's dilemma? So the greatest obstacle to AI transformation is not technological or regulatory, it's organizational. So the organization of the successful players is a big barrier to innovation. So we have to some extent symptoms of an innovator's dilemma in the industry. The established firms have optimized their workflows, their processes over decades for the existing business models. But as regards AI, they respond incrementally. They do not think about structural transformations. They bet on AI improving existing processes, and they fail to prioritize data competence over seniority. So it's a big issue in the industry. And so to give some strategic advice is very simple, and it's related to the work of Clayton Christensen. Asset managers should not integrate AI initiatives into existing departments. AI initiatives need own budgets, own decision pathways, the freedom to ignore existing processes. So it needs a kind of autonomy in order to develop AI and to set AI productive in the incumbents' processes. So we have the risk that established firms fail in their transformation. They integrate AI teams into existing structures where they are typically absorbed by the gravity of the status quo. So finally, what happens next? We know that AI will change the financial industry. We know it will change asset management because the chance to better invest in capital markets, to make better investment decisions at lower cost is real. So all the potentials are very, very clear. So what are the implications for the asset managers? The asset managers must decide to take leadership in the transformation. To take leadership in the transformation because the pressure to transform the industry is really big. There's a lot of cost pressure and there's performance pressure. So it's no alternative to wait for the best practices to show up and then act. I think it's a good decision to shape the transformation rather than be shaped by it. And the question is not whether it will transform the industry. The question is which firms will lead and which firms will struggle. For investors, there are also some important implications. We do not have long track records of AI-based investment strategies. So we have to look into the machine rooms of the asset managers, of the providers of investment products. We have to adapt a little bit the due diligence in order to identify firms that do AI washing, which is observable all over the industry. Some critical areas for assessment include competence. Does the asset manager have the competences to really develop AI and to integrate AI in the processes? The architecture of data and model infrastructure. And finally, the governance of the AI deployment. So these are important areas for due diligence into investment products or into asset managers. So if at some point the human being is still existing in these processes, I think that's a good sign. It's a sign of an expert handling of the transformation. That's it from my side.
Thank you very much.
And I think the floor is yours.
Thank you very much. So I think we then can move on to having some further insights from the rather academic side, probably.
Yes. Okay. So thanks to all for coming and for joining. These comments that I start with are going to be based primarily on a current working paper that we have with Matthias Rumpf, who works at the Bundesbank. So I have to say that the Bundesbank does not believe in what we say, is not responsible for what we say. Okay. And Tatiana Kosiakova and Thomas Otter, who are from the marketing department. So people at Goethe University and now in Tatiana and HHL. So there is a little bit of interdisciplinary aspect as well. So what we try to do in this paper is to combine three possible sources of advice: advice from professionals, advice from peers, and advice from LLMs. And the key motivation, because we are talking about LLMs and AI today, but the key motivation for doing this is a well-known line which says, old age is bad, but it normally beats the alternative. Okay, so it always depends on the alternative. How good AI advice is has to depend on the alternatives that people have. Now, statistics have been mentioned, and it's actually interesting that there were statistics from Germany initially. And these statistics are from the US and from the UK from last year. And you can see, in some sense, how things are penetrating, how AI is penetrating, or LLMs are penetrating advice. So 51% of US consumers used AI for financial advice in the past 3 months. That was in the US. If you go down to the UK, 56% of UK adults, but in the past year, right? So the time period grows. And then in the US, 52% of those who used it used ChatGPT, and particularly popular among those under 40. And in the UK, 39% of those who used it for longer-term planning, such as pensions. So the thing, and the German numbers were a little bit lower than that, but it seems that everything will be moving in the same, is likely to be moving in the same direction. Now, there's a bunch of questions that we try to ask in this work. So first of all, we try to elicit beliefs on optimal portfolio shares by showing these three different groups: professionals, peers, other lay people, but also to ChatGPT 5. We are showing vignettes of potential clients. And we say, okay, get a person with these characteristics, what would be the optimal risky portfolio share for a person like that? So there are no incentives for professionals. There are not getting paid, they're not getting anything, and nor do the others, of course, get anything from giving one answer rather than the other. So this is as close as I think we can get to eliciting beliefs of these different groups about optimal portfolio choice. Then we take those and we run regressions and we see how the advice responds to investor characteristics. So which characteristics do different groups systematically respond to and in which direction. And then for the humans, we also have some of their own characteristics, the advisor characteristics. And we see how their advice responds to their characteristics, controlling for the characteristics of the vignette of the client as well. And then we are able to estimate distributions of advice. And that gives us an idea of the possibilities, the possible advice that somebody would get by picking a random member of the two human groups. And maybe you say, okay, how can you do a distribution of the LLM advice? But actually what we do is we give an identical prompt to ChatGPT 300 times, giving it the same 4,000 vignettes. So we are collecting 1.2 million responses. And what we see is you can ask the same question, but you're not getting the same answer, with the same vignette, but you're not getting the same answer. And you are getting a distribution of these answers. And we are able to, you can see this in a number of emerging studies that this happens. And then you see it in footnotes, maybe some cases, algorithmic stochasticity, or something, random error being added to the recommendations. But what we actually find is that the coefficients, the mechanism, the rules that ChatGPT applies are shifting across these repeated executions of the same prompt over a very short period of time. And then, of course, can LLM advice fill gaps that we know exist in professional advice? There have been a number of papers, and I think most of you have come across them. I want to highlight the Mulainathan et al. Paper, which is still not published, but it found catering to characteristics, and that was in the first visit to a financial advisor. I want to highlight the Linai Ma and et al. Paper, which finds that professionals' own portfolios are very similar to the portfolios of their clients, right? And this continues, and the professionals continue to keep on to these portfolios even after they retire from the industry, etc. So a lot of what they are advising seems to be motivated by their own beliefs. There is a counterexample of Levitt and Syverson. They are looking at real estate agents, and real estate agents don't necessarily do themselves what they are telling us to do. So that's a different take. And then on robo advice, the Choi da Rossi paper has been mentioned already. There's this other Huang and Yang paper that humans elicit information that robots may miss, unarticulated needs. There is the very interesting paper that we're going to hear tomorrow by Chukmanahed, De Silva et al., comparing LLM advice to models, to life cycle models. And I think we're going to learn a lot from that. And it's it's complementary to what we are trying to do here. And of course, there's a lot of literature on peer effects. Now, what we like about our exercise is, okay, we are comparing these three things, but secondly, the vignette design is actually very good because many of these pairs we don't normally observe in practice. So for example, the young are much less likely to go to professional advisors than the older and wealthier people. So we don't observe the actual advice given or that would have been given to these people, but now we are asking the professional advisors to do it, for example. There are no incentives. Okay, so let me just summarize the findings. First of all, on humans, on the two types of human advisors, professionals versus peers, both professional and lay advisors are systematically influenced by their own characteristics in the advice they give. And sometimes, and the portfolio risk that they have in their portfolios. And actually, we find some cases in which the professionals are even more influenced by what they're doing themselves than what the peers are doing. And is this necessarily, a bad thing? Some people say, okay, it's what they know best and what they are trying themselves. But of course, if they have their own preferences and their own biases, that also creates the possibility that their clients are being influenced by that. The beliefs, if we are looking at how the humans are responding to the characteristics of people, of these vignettes, these one can reconcile with theory, what we know from household finance optimization theory, etc. These are not crazy responses to characteristics, neither from professionals nor from the lay people. Professionals, we find that professionals respond more strongly to some characteristics of the vignettes, of the clients, than peers or lay people would. And that is age and risk tolerance. But they are not more responsive across the board. So, for example, they are not responding to investment amount. The peers, when they see that you are investing a lot, they are recommending less risky exposure, maybe because they're afraid you might ruin yourself, etc. This doesn't seem to be happening systematically with the professionals. These peer recommendations, we have been doing peer effects research for a number of years now, and we're always thinking about imitating, about copying, about learning, etc. But these peer recommendations can also be of what portfolio to have, can also be an interesting mechanism to think about. How about LLMs? So I already mentioned the first result, that these the sets of coefficient estimates differ across the 300 prompts. And if you look at the distribution of the estimates, the standard deviation of the coefficients is orders of magnitude bigger than the standard error of each estimation that we run. So it seems that the model or the response is shifting around. The second first order impression is that the LLM is really responding an awful lot to risk tolerance, to expressed risk tolerance, dramatically higher than for any human investor type. You can see it in the coefficients, you can see it in the distribution of advice from the LLM. It gets shifted dramatically to the right, to more risky recommendations as you declare more risk tolerance. The third finding is that the ChatGPT doesn't, you cannot say ChatGPT is closer to humans. It's behaving more like a human, or it's behaving more like a professional. It occupies its own position relative to characteristics. But what you can say, or at least what we estimate, is that the distribution of this advice, I mean, I told you there is a variation, across the 300 prompts, identical prompts, but the distribution of advice that you are getting from the LLM, from ChatGPT, has much smaller variance. This advice is much more concentrated than what you are getting from professionals or what you are getting from the, or we're estimating you're getting from the peers. What stands out? Most variables that move human advice move ChatGPT advice in the same direction. We don't see dramatic reversals or many of them, so that's mostly the case. The risk tolerance I already mentioned. Regarding age, the ChatGPT responds to age, and it responds quite a bit, and it responds more closely to what professionals do than to what lay people do. We do find a reversal with the investment amount. As I told you, if lay advisors are seeing you investing more, they will moderate their risk recommendation. The professionals don't seem to be responding systematically. ChatGPT actually is telling you to invest a higher risky share. Now, you may say, okay, how can lower and higher be consistent with theory? They can. If you think the life cycle hypothesis, there are two, or if you think of the Wachter-Yogo model, there are two competing effects there. One could get richer people to lower their risky portfolio share. The other could get them to increase it. But we do find this, and then differences with real estate wealth. Okay. Now, policy implications. That's the final thing. What we are finding actually in the distributions, etc., is that ChatGPT is recommending to young people significantly more risky exposure than their peers or the other lay people are recommending. And financial advisors would also be recommending significantly higher exposure, but they don't meet them, right? Because young people don't go to financial advisors. But young people tend to be using LLMs. So it could be that more widespread use among young people of LLMs is going to encourage stock market participation and risk taking by these young people and help fill the gap as well. The final thing, wealthy retirees who start using AI, they need to declare a lot of risk tolerance before ChatGPT is going to tell them go and invest quite a bit in the stock market. And if they don't do that, they are getting much more conservative advice than what they are getting from their peers and even from the financial advisors. So I'll stop here and we do.
Thank you very much, Michael. I think there was a lot of food for thought in all these introductory statements. Many of the questions that I had in mind I think already answered. But I think maybe that's a question to all of you. What I would still like to elaborate a little bit on is where will financial advice, or from whom will financial advice in the future be provided? Will it be really the generative AI that will people use ChatGPT, or will it rather be provided by banks, other financial service providers, within banking apps, within other integrated products? Where is the larger value added? Will we have both simultaneously in the future? Is there any competitive advantage to incorporate that into banking apps or in other direct customer front ends? Or will people continue simply going to ChatGPT or alternative sources and never use their banking app in order to obtain this advice. Do you have any opinion on this?
Should I start?
Yes.
So, from what I learned interacting also with the fintechs that we see around, is that, I mean, traditional advice will maybe stay in banks for a while at least, but I think it will be very, very product specific. So, for example, when you have a more complex financial product like a mortgage or something, people still want human advice, right? And they do not really trust the AI. And I think this will stay for a while. Let's see how long it goes. But if you look, for example, for other things where chatbots are already integrated in a way you could really use them, or whether they give you recommendations based on your individual portfolio, not very broadly speaking, this is all not done by traditional banks at the moment. And I think this will maybe be the answer to that new market entrants will provide the advice in a very interactive format, and the banks have to see whether they will be fast enough to compete with these. That's my opinion.
Very interesting point. Are you all sharing the same perspective, or is there anything?
I think we are at the beginning of the development. Currently, we do not have innovative market entrants in that space, because the market is regulated, and it's very, very hard to get into the market with a product linked to financial advice. So the innovation is not in the big players that are already in the market. The innovation is in the small companies. I think the challenge for the small ones is to get into this regulated environment. And when they are successful in achieving that, I think we will have a threat from that direction. But currently, I have the impression that the human being is still very important, and it's a matter of trust. So the question is, will chatbots be able to build up trust, competing with the trust of human beings? And I think it's a hard question. Currently, we are at the beginning, so we will see how the development goes.
I could bring a perspective from a different angle, because I'm at the Bundesbank also responsible for data and statistics. And actually in that sphere, ChatGPT and the offerings are really a challenge, because people do go for whatever statistics to ChatGPT and download some data, but these data are incorrect. So the question, and so I think there is something to be learned from this for the financial industry as well. And I could imagine it could be a challenge that is faced in that area as well. Because so for us as providers of proper statistics, following due process and checking and so on, the challenge is, how do we help people use correct data as opposed to going to ChatGPT, downloading some data, thinking that, oh, this is the GDP of Germany, while in reality it's some number that has some probability of being correct. And so that may be a similar challenge for financial advice as well, no? Because, and I found very interesting the point that you made about older people getting less risky advice. I mean, when you think about it from a theoretical perspective, that makes a lot of sense, because then the investment horizon is much shorter. No? So I would also say the probability that you get less risky advice is also high. But I guess that's a challenge of that type of model that we're seeing right now. As long as we have the transformer models that are working with probabilities and thereby generate the advice, as those main used models, we may face those challenges. And I could imagine that, because if I think about investment decisions, no, of course I would benefit from analyzing fundamentals for asset returns or whatever, but that really requires some knowledge of modeling,
Yeah.
of risks, of modeling, of asset prices being built, and many people don't have that knowledge. So they go to an LLM that doesn't have the knowledge, and in fact, if you had the investment been put in analyzing with the help of models, data available, of course you would bring much bigger value, but it's just that people may be not aware of actually the cost of going to a large language model, as they do when downloading data from large language models without knowing that those are not proper statistics.
Yeah. Yeah, so I mean, related to your question and our discussion, I mean, I think a lot depends on whom we are talking about. So are we talking about the young, the starters, the less wealthy, etc., or are we talking about the older, the wealthier, the more experienced and all of that? And I think initial conditions matter. So if you are used to having a professional advisor that you know and that you trust, and this person has guided you for many years, I mean, to replace this person with a machine, I think is going to be much more difficult. And I think there might be a bias in that direction. But I think for the young, it has always been a problem that the young are insignificant in terms of the amount of investment. It's not a good use of advisors' time to talk to the young, and how to do this matching has never, been solved so far. Whereas the young are, very technologically capable. And I want to bring in, and then you may say, trust, will they trust the machine, etc. I want to bring in an experience that I've had talking to some young people. Of course, at the university, I talk to lots of people, but in my family and extended family, I can talk to them about their personal stuff as well. And what I hear now increasingly is that when they are having trouble with their boyfriends and girlfriends, they ask ChatGPT.
Yeah.
Okay. And if, and this is different, right? I mean, you build trust in one domain, where it might be working better. I mean, I don't know if they are breaking up after that, but it might be working better. And then you think, okay, it has helped me in this domain, then I can go to the other domain. So I think there, for the young and the inexperienced, I think there is a big market there and a big applicability.
Can I add something to what you said? Because I was talking to a CEO of a big savings bank and she told me that they are currently also screening the influencers in the web to prepare their advisors, because people come in and ask for specific products that were like advertised the week before, and these are products some of the advisors have never talked about. So there was one week where, this is maybe not so fancy, but where everyone wanted silver because some big influencer mentioned that. And I think these interactions, so even if you stay with a human, I think what we also see in our paper, right, that when we look at recent investors, it's rarely the case that they only became investors through social media. It's often an interaction with family and peers, and we do not understand perfectly whether they first go to the family and peers and then consult social media, or whether it's the other way around. But you see that it's an interaction, so we have to learn to deal with that, also to respond it, and the advisors have to also maybe debias people after they have used the wrong statistics. But if they trust in them, it's very difficult. It's a bit like all the doctors who now are consulted by patients who already know what they have before they have seen them. So it's a bit like that, I think.
I think we have to specify what kind of advice we are talking about. Are we talking about advice on the structure of a portfolio, which is easily done by ChatGPT? Or are we talking about investment advice today for a period of 1 month, 3 months, 5 years. So it's a difference. I think the transformer models are not able to give this advice because we are in highly efficient capital markets. Even if we assume some inefficiencies in capital markets, it's very hard to give investment advice continuously that outperforms the market. I think in order to do that, you need some knowledge on valuation. You need to know how fundamental variables, market developments interact with prices. So you need asset pricing capabilities. And in order to implement asset pricing in AI, you are in the area of machine learning. It's a different thing. It's the use of neural networks, of decision trees, and so on, regression models, etc. It's a big difference. So I think to give some advice on markets, what instruments are there, on portfolio structures, on strategy, long-term strategy, life cycle, blah, blah, I think these transformers are quite performing, but as regards investment advice over time, they are not able to give correct indications because they're not able to do that. They simply use probabilities in existing data and text, and that's not enough. In order to give investment advice, you have to make a prediction. And these prediction models require the application of machine learning. That's the difference.
I think that's a very interesting point, and brings me also to another question that I had. I mean, so far the perception of humans and advice was very positive. They have trust. That means that they typically also provide very valuable advice. But we also had quite a number of instances where this advice was basically being abused, or this trust was being abused, right? Where households were sold certificates that they just didn't understand, right? There were products being designed with the purpose of confusing retail investors and take advantage of their incompetencies or their financial illiteracy. And I was hoping that potentially, I mean, the large language models could potentially provide there a less biased advice and be a neutral, provide a neutral valuation of those products, providing also more transparency. But if I understood you correctly, then it's rather the opposite. Then they are probably not so useful.
I think LLMs are able to analyze products and to elaborate pros and cons, risks. You can feed them with all the information on products. I think that's not a problem. So it's navigating the complex reporting and structure of an investment product. I think they are very successful in doing that. My point is, are LLMs able to make a proper investment decision that has the potential to outperform the market? Maybe tactical asset allocation decisions or equity selection decisions. And I think they are not able to do that because they have no ability to do that. They have not learned to do that. So in order to make that possible, you are in a different area of AI. You are in the area of machine learning. So that's a difference. So these large language models are different from, let's say, neural networks, decision tree concepts that can be connected with our knowledge on the valuation on capital markets. And LLMs are not able to make this connection.
But wouldn't in order to assess whether a particular product is properly priced by the issuer, whether a particular certificate has too high fees, I mean, they also need some valuation. But isn't that suffering then from exactly the same problem that you were alluding to?
I think that kind of advice is possible, to compare products, to elaborate pros and cons of products, to compare products to each other. I think that's a nice task for an LLM, processing the huge amount of data on the products, including also the track records, including the risks, the active risk, and so on. That's possible. But my point is, are they able to make an investment decision like a chief investment officer does every day? I think that's not possible by LLMs. In order to do that, you have to connect what we know about the valuation in capital markets, asset pricing, with machine learning systems. And this is not incorporated in LLMs. In order to do that, you have to implement these learning capabilities, and you have to start with some structure in designing these models. So we started developing machine learning concepts 8 years ago in order to make equity selection decisions. At the beginning, I believed that's enough to have a neural network, let's say neural network or ensemble of neural networks, decision trees, and feed this concept with data, without any theory, without any structural requirements. So it was quite disappointing. I think that's a learning of the research in finance, that you need to impose structures on machine learning concepts in order to implement successful investment decisions. That's a learning. But at the beginning, we all thought, wow, they are so powerful. We do not need any structure, nothing, and we can confront them with data, available data, but that's not working. Our learning, our common learning in the industry is that you have to impose structures coming from financial market research. So 70 years of research, starting with Markowitz in 1952, cannot be thrown away. That's how the market is working.
So you say it helps with education, right? This is
Of
the part
course.
where it can
Yeah.
help the households, right?
Yes.
If I understood you correctly.
Yeah, definitely. But this is a task for the LLM, to help them navigate through Markowitz, Sharp, capital asset pricing, multi-factor models. I think in this space they do an excellent job.
Yeah, I think your question also had a little bit of a regulatory aspect to it, right? You know, mis-selling and etc. And that's also an interesting thing to consider. And we recently had a little bit of experience. We tried it, you know, also in this project, and we said, okay, MiFID 1 versus MiFID 2, and are you being, ignore MiFID 2, just do MiFID 1, how much are you influenced by it, how much does your advice change? And actually, we then did it for today with MiFID 2, and the difference is not perceptible, so it wasn't much of a change. But then we prompted it. But then there is the issue that the ChatGPT, you can ask it to ignore something, but it doesn't forget it fully, right? So it is an issue there. But then we sort of asked it directly, how much are you taking into account ChatGPT? And then, MiFID 1 versus MiFID 2, etc., regulation. And then it became a little bit defensive, right? And it started adding, the recommendation we are giving you, does not necessarily comply with all the regulations, etc. I mean, they're trying to get out of trouble. But the more substantive part of the answer that it gave was that they are responding, they are trying to incorporate a sort of the general atmosphere, climate, views, understanding, and it's not very specific on, evaluating this particular ratio, that particular ratio, or making sure that, all the regulations are being filled. And I'm saying this also because we had, maybe 10 years ago, I mean, it was a long time ago, we had another policy event in this network, and we had, I believe, the CEO of Better Finance. I think CEO of Better Finance, but it was some maybe the name is not correct, but it was some robo-advice person, major robo-advice person from the US, and his argument on regulation was, you can regulate us better than you can regulate humans because we have algorithms and we can give you the algorithms and you can check those algorithms. But I'm not sure this is true now with the LLMs, where it all becomes a little bit wishy-washy, and the spirit and the general thinking, but not the specific algorithm that we follow.
And I think if I may add to that, it's a bit more complicated than that even, no? Because it is, I fully agree with you, Peter, that you basically have different models for financial decision taking. What is very relevant for the outcome is also with what data do you train those models at the end. No, you have the structure, and that may differ. And you can have very different types of models, and you can train those different types of models depending on the structure that you put, or the quality functions that you give your model to to start learning on those structures that you impose. And from a regulatory point, or from a supervisor's viewpoint, it is, and that was the finding that I alluded to from the research center, it makes a huge difference in terms of how those models in their interaction affect the market as a whole. Now, and in that sense, I think, Michael, it is a bit more complicated than that, because it then at the end depends on the type of model. And yes, it's true, it may be easy in a way that this is a machine in a way that you regulate, but it requires a lot of transparency to know what type of model is used, what data is it trained upon, and it also brings additional challenges with our legislation. Because when we think about competition law, for example, you need human beings to agree on an action, for example, for competition law to actually, in German competition law, to identify something as collusion, for example. But if you have models collude because they have been trained on very similar data, what is this then? You don't have an agreement between humans to take a similar investment decision that at the end leads to a very large movement within the market. So I wouldn't fully agree with that argument, I think, is all I'm saying.
Just to clarify, I was saying for robo-advice, I think it made more sense.
Yes. Okay,
for
fair.
LLM now, I fully agree with you that it's very nebulous and it cannot be observed. Yeah.
I would like to add something on data, because data is a big issue in the development of AI. For instance, if you use data from the data providers, and we know the names of professional data providers, this data often has forward-looking biases. So they overwrite their data series exposed. And if you use that data for training models, the models learn the future, and that's a big problem. So in order to have rigorous training, you need point-in-time databases. And we spend 80% of our resources invested since 2017 in cleaning and structuring data. Algorithms are available all over the platform's internet. The main thing in the development of AI is cleaning data, trying to get proper data, market data, company data, and so on. If you don't have proper data, you cannot use the model. That's the problem. The models are very sensible as regards forward-looking biases in the training data, and that's a big difference to the econometric models we used several years ago. They are not so sensitive as regards these forward-looking biases, but the neural networks are very sensitive.
I would actually like the opportunity to talk a little bit more about data, but from a different angle. I mean, also earlier what we discussed whether AI will be integrated then into banking apps to provide advice, or whether it will be rather used by whether households will rather use ChatGPT in order to obtain financial advice. I mean, it also matters where ultimately you store your data, your personal data. Right, very detailed income data, your consumption data. I mean, everything is now basically available for your bank. But if you want to have basically advice from ChatGPT, you also have to upload your data there, which might have also different implications on privacy, data security. Will that be an issue? Will that also be something that households will consider when deciding where to turn to in order to get financial advice? Will that be a factor affecting the industry developments here? I mean, naturally, I think we have good supervision on the banking sector in order to make sure that data is safe, kept safe there. But I think with ChatGPT, with OpenAI, with Claude, with Gemini, we don't really know where the data ultimately ends up in, right? Do you have any take on that? Is that something where we need to also protect potentially from a regulator's perspective, households not to basically give away their private data to sources where they don't even know where it ends up?
I had an interesting experience on Sunday. I landed in Copenhagen, not to visit Stefan, to go to University of Copenhagen. And the minute I landed, my iPhone, Uber and Volt welcomed me to Copenhagen. And then I checked immediately the permissions that I had given to those two apps. And I had said only when using, location only when using. But I was not using those apps, and they still. So in some sense, this is one idea in which you say I give up. So many different apps, etc., know so much about me, and if they can give me more tailored advertising and all of this, it's fine. I don't particularly care, but. So that's one approach, and another approach is I don't want anybody else to know anything about me, and that's more the confidentiality approach, etc. And I know Germans especially are very, very, very fond of this particular idea. But I also want to say, from the point of view of research, and we have had these discussions in this network a number of times, we hate confidentiality, right? We love Scandinavia, where you can get so much data, and link so much data and all of this. So there are different perspectives, but I would like, I don't know, I would like to hear what other people think about how much control we actually have today, given the technologies about, of our data anyway, that we should be concerned about ChatGPT. I mean, I don't know.
I mean, my thought was, I'm stepping out of my role as a moderator here, but I mean, given that we get that the large language models are really learning from every prompt that you're giving them. I mean, if they also get your portfolio, your consumption structure, I mean, this is something where you really end up in a confirmation bubble, because they will then also recommend to you products that you have bought, right? If you're a smoker, you will get continuously, potentially, advertisements for cigarettes, right? So I think this is much more severe than the information that Google has probably from our past searches, right? And giving us the confirmation.
It's interesting. When asking Claude what happens with the information that Claude has learned from personal interactions, and if other users would be able to learn from it, Claude answers that there is a short and a long answer. The short answer being that as per user agreement, other users cannot use the information and that is stored in the personal chat memory. And then the longer answer is, however, the company, of course, also has access to those memories and that it may use them. So in that sense, I think this is, and of course, I mean, here I will speak from the perspective that I'm responsible for the IT at the Bundesbank. These data privacy concerns are very relevant to us. And in our AI strategy, we had one goal to basically democratize the use of artificial intelligence, and we did this by providing a platform through which Bundesbank colleagues can use different platforms, but basically the prompts do stay on our servers. They do not train the models. So I think this is very, very relevant. But still, there are restrictions on the data that we're allowed to put into those models precisely because of questions of confidentiality, and there is this balance to strike, about in that case consumer protection, privacy, and innovation. On the other hand, I'm not sure. I have the impression that in Germany we have to very carefully look into this topic, because in some areas I think we bind ourselves very, very strongly when we talk about data protection, and in other areas there is very little protection. Talking about you're okay, that was in Copenhagen, but still, I mean.
Yes, no, I fully agree, and going back to the to Falko's point, I think there are two things: how much the LLM learns, and second, how much it caters, right? Because that's what you have in mind a lot now. That's a very good point as well, how much it caters to your preferences. So is it going, because if I tell it, the sun is coming out of the west, right? Is it going to tell me, oh yeah, you may be right sometimes, or is it going to tell me you're stupid, this is not true? And I'm getting the impression, at least, what I'm seeing, etc., that there's quite a bit of catering, and that's a problem. That's a problem.
That's what the paper by Loriana and Florian Head shows, that the AI increases the biases because of the catering. And I think another question is also whether people are aware of what is done with the data. And I think you see this, for example, in the buy now, pay later business very, very nicely, or in consumer credit, where people buy through merchants and don't even know where their credit score is coming from, because a lot of merchants don't even buy the Schufa score anymore, because they say that we can predict it much better. And they use things about your past purchases and all these kind of things. And I think that a lot of people don't know. When you, for example, look at this this paper of Manju Puri and Tobias Berg, where you see it matters whether you use capital letters or not. I don't think that many people know that this makes is used for the decision whether they get a loan or not, right? So these kind of things, which is not exactly AI, but I think in general we have lost like the awareness of how are our financial decisions in interaction with the industry made, and I think this is like a problem.
Absolutely. I also want to build up some trust and reputation and stick to my promise to open up the floor for discussion. But before I hand over to you, and maybe you want to think about questions already by now, I cannot let you go definitively without asking you, all four of you, where do you see the most important research gaps in the field of financial advice, household finance, and AI, given that we have a lot of committed young researchers here that are eager to define new projects? Maybe you have some advice for them. Michael, do you want to go first as the grandmaster of household finance?
The best advice is never to follow an advice, because then you can be original and do your own thing and impress everybody. But I think, the things that we are talking about today, trying to, who is more likely to be using this AI and for what purposes? What might be barriers to AI inclusion, right? We have the financial literacy, we have education, but we also have tech literacy, etc. One thing I must say I have noticed with LLMs is that you don't need to know math to pose very mathematical problems, right, and get answers. It's all quite verbal. So this may be opening up possibilities for our humanities colleagues who are so smart, right, or lawyers or whatever, so smart, but they don't add and subtract. Well, I mean, they do. Okay, but so these are possibilities as well. And then, of course, what Christine was mentioning, the discrimination issues are very important. And then, the I/O, the competition aspects as well. What happens? Is it going to be, one LLM, two LLMs in the end, and everybody will be copying those, etc., or not? And then the catering and the heterogeneity of advice that they give. Because, if everybody, financial stability issues, they arise from lots of people doing the wrong thing at the same time. So if you have a platform that gives advice to many people at the same time, you have the potential for a lot of instability, right? So to try to understand how this is, structured. So I would say, these are some of the things, but what I'm concerned about is data, right? Because of course these providers, the LLM providers, get tons of data, but how about researchers, right? And to what extent will they be willing to share? I know there are some studies that are starting to use provided data, but how are we going to answer these questions if we don't have the characteristics of the people using the things and the answers that they are getting? And so we have to think about how to generate these data sets ourselves.
Thank you. Peter, do you have any advice?
So I'm not familiar with the most recent advances in household finance, to be honest. But I know that, let's say, 90 to 95% of financial advice today is a mapping of risk tolerance and risk capability into standardized, let's say, asset allocations. So it's aggressive, balanced, and moderate, something like that. And what I think would be interesting is to explore a little bit the relation between the personalities of investors and their best fitting optimal investment portfolios. So using the personality traits, there are some models on that, in order to create a better mapping of people into the investment world. I think that's an interesting topic, and I would sponsor that.
Oh, well, thank you. Steve?
Yeah, I would be very interested in the general communication and interaction with AI, because I think the barriers are super low, but it's still a help for self-help. So if I do not ask any financial question, the AI will not tell me anything. So I would really like to understand what people ask, how often they use it for finance, but also how deep they go. Because for example, we know that specific groups go to advisor for a second opinion, and some just want peace of mind and get it done. And also with AI, it could be that you ask a question, you read the first line, but do not read why this is the case, right? And I would really like to understand whether people make use of it, like asking follow-up questions or not, or really how this interaction works. So.
Thank you. Fritzi, any advice for the research center?
Well, maybe a wish list. No, of what I think, and it's not very surprising that I'm saying that, but I think that there has been a lot of research on financial stability with financial instruments that we know. No, and when we look now at the use of artificial intelligence in traders, my understanding is that we really need to revisit a lot of the findings that we've gotten to, assuming that there are human traders at work. So I think that makes a lot of sense to delve into this. This is not precisely household finance and financial stability, but I think it is a somewhat related topic, and from a central bank's perspective, that is very critical.
Thank you. So thanks very much. Now it's your turn. There's one question. Yes, please. Martin.
Okay, so a question to Christine and to some extent to Michael. So you said that AI discriminates by giving worse advice to women than to men. And you also said that AI is kind of useful in giving advice. So one thing that I didn't notice you kind of talking so much about, I mean, Michael hinted about that, is that what we know about the use of AI is that there's actually kind of a gender gap in AI use, so that men are much more likely to use AI than women. So how do you see this affecting the gender gap in financial advice? And then kind of one clarifying question still. So can you kind of clarify what you mean by discrimination when you are talking about AI financial advice? So are you talking about statistical discrimination, or are you talking about test-based discrimination? Because usually when we talk about AI, we think that it's quite rational, and that's why, at least personally, I would think that the kind of a test-based discrimination would be less likely.
So when I talked about discrimination, I was talking about statistical discrimination, but with the AI study, they do not really explain, and this was not my own study, but they do not really explain where it's coming from, because of course it could always be that the AI also used gender as a proxy for whatever, something, right? So and I'm not sure, it's not clear whether it could also be that it overestimates the risk preferences of men. So it's not clear whether it's discrimination. It's just giving the same profile. It gives you different recommendations for men and women, like putting a lot of things into it, a lot of characteristics. So it doesn't seem to be similar in the recommendation if you exchange the gender. And so what of course I think what AI could increase, but this is like now gut feeling based on what you ask, is the knowledge gap, the literacy gap in financial literacy even further, because if men are more likely to use it and it's super easy to get feedback on questions and to learn, then it's also likely that men are more likely to increase financial knowledge even further, right? And I think there will be a lot of potential if the things that happened in the last years, also through people on social media, will increase the awareness of women of what you can do in investments. Because for young people, you see the large increase for female participation. The gap is still large between men and women, but what you see is that women are more likely to at least ask questions. And I think AI can provide solutions, especially if there are some providers which will enter the market with a different way of communicating. But it's a very interesting question, and I hope that I will maybe be able to answer some of that in 4 to 8 weeks when we analyzed our chatbot interactions and see how men and women interacted there. So I'm very curious about that. It's a very good question.
Yeah, I want to say in our data, we didn't find a sort of reaction to gender in any particular way. But of course, with the vignettes, you don't have the issue you also mentioned, who is more likely to use the thing. I mean, you don't understand that at all. I think it goes back to the earlier discussion we had. Is it democratization that is going to happen, or is it going to be, making the more educated and the more aggressive in the use of AI even better off, with bigger distance? It gives women a chance to challenge and to test also what men are telling them, right? That can be let me check if what you're telling me is right or not. So there are positive aspects, but I think it's probably too early to tell. And
Thank you. I think that Jonathan had another question.
Yeah, hi, thanks very much for that. There have been a couple of mentions of social media. So I wanted to ask Michael whether the lay perspective included anything to do with what's out there on social media rather than the family perspective. And then thinking families and friends, and then thinking slightly more broadly, I think that the point that you were making about what the alternative is super important. And it may well be that AI is pretty unreliable, but if the alternative for lots of the people who really need the financial advice is going to social media, the question is really, how do those two play off against each other? So I'm interested in the perspectives of the panel on that, and then in particular also how that relates to regulation. I'm not quite sure how it's working in Germany or in other parts of Europe, but in the UK I get the sense that it's very hard for regulation to know how to respond to the provision both on social media and via LLMs. We have quite a stark distinction between regulated financial advice and other stuff. And these are sort of falling a bit in between the gap, and you can probably induce an LLM to give you something which you should count really as financial advice, but it isn't regulated. So any thoughts on how that can be navigated would be really useful.
Yeah, I mean, on social media, I mean, we didn't do anything in this study, but we had, the study with Christine, we asked real Germans, about in depth about what they are thinking about money and eventually about the stock market, etc., etc. And one of the things that some people mentioned was, of course, social media, and they are influenced by this. And we had one person who was so excited about social media who said, I have to invest in the stock market because my friends follow social media and know so much about the stock market. So it's like football, right? You have to know something about it, otherwise, you're socially excluded and things like that. But then when we went to the big survey, we didn't really find much of that. So I don't know if we have a lot of hard evidence on, really dramatic influence of social media on stock market participation, for example, or on financial behavior. There are the finfluencers out there, of course, and they are getting lots of likes and followers, but I don't know if we have such studies. I mean, maybe colleagues here are aware of such studies that establish that. And with respect to regulation, as I also mentioned, these prompts, etc. I mean, they don't feel. I mean, feel. Okay, that's not the word, but they don't act or decide or recommend based on strict rules, and it will be quite difficult to bridge that gap for regulators, I think. Because in the end, regulators cannot see what you're doing, on your phone late at night and what kind of advice you're getting and, what you told your phone, what information you gave it, what prompt you gave it, etc. I mean, I think it's going to be a tough cookie, this thing.
Would suggest that we probably collect the last two questions, and Filippo,
Okay,
go first.
Coming from the litigious society where I live, it was very foreign to me that we had a whole conversation without touching on fiduciary duty, right? There's financial advice, which is just people talking about money, which is taboo in many cultures, and people still don't talk enough about money. And there's going to be differences in which how much I talk about money with my peers versus with a robot. But are we talking in equilibrium about the end of fiduciary duty in the sense that now if I provide an AI to provide people with financial advice, that is paid for under fiduciary duty. I need to insure legal risk. And so then I'm going to pass the cost of that insurance to the consumer. Then I'm going to have a dual equilibrium where rich people that really want to insure that are going to pay for that service. And then poor people are okay with no fiduciary duty advice and are going to get advice that's not necessarily committed with protecting their best interest. And so how do we see in equilibrium the role of fiduciary duty in the actual advice, not just chatting about money? What are your thoughts?
We don't have a lawyer.
Question.
That's tough.
Yeah.
I think, I mean, I cannot answer this question directly, but what I'm always concerned, or what I find very interesting and concerning as well, is you said that at the moment the chatbots do not give really advice, right? So, but I mean, it's not claimed to be advice, but there are some brokers where you get information about already your individual portfolio, claiming that it's not advice, right? And this is not responding to your question, but I wonder where we are. I think a lot of people cannot distinguish between we chat and we get advice, right? So from the household, from the consumer perspective, and this is something which I find very interesting because also that this is possible at all in a way, right? Like allowing as a financial provider these interactions, not giving advice, but customer perception is we are in the advice space. And I mean, I'm not a lawyer, but this is something which I don't know how to think about this. This is more an additional question to your question because I have no response, but I was thinking about this as well from observing just what is out there. Yeah. So maybe you will know more about.
I think in the end there will be some structure responsible for the fiduciary duty. There has to be one.
Yeah.
And this will be regulated for sure. So the question is, where is the communicating AI located? Is it on this platform, or is it a new surface, or is it integrated, or is it, I don't know, but in the end we need structures, regulated structures taking the fiduciary duty. I think there would be no alternative.
And I mean, I very much agree. And on the other hand, I mean, I'm not entirely sure that it necessarily leads to the segmentation that you were hypothesizing in your answer. Because ultimately, I think these are fixed costs, right, to establish these systems. So in order to, so it can be scaled up and made accessible then also for poorer investors because the marginal costs will be basically zero. So I'm not exactly sure to what that your argument that the legal costs here will lead to necessarily a segmentation, but that's just my take as a moderator.
It depends on the insurer business model as well, right?
Sure.
Yeah.
Finally, very last question, Niels.
Yes, I had a quick question about it. Goes a bit to Michael's paper. The way you interacted with the AI is kind of like already like a quite sophisticated person, right? I want to split my portfolio between an S&P 500 and some bonds. I mean, this is already you're like in the upper whatever % of like financial literacy. And I mean, it was already mentioned by other people. Like, I'm really interested how people actually interact. Are they going there and asking for the best crypto advice, basically? And then the AI happily provides, like, this is the best crypto asset here and there. So, I mean, sort of, what is the demand what do people demand from the AIs? And then sort of, this can be quite different than like some sophisticated person goes there and should I invest like 50% or 70% in equities? So do you have any sense of that?
The short answer is no. I mean, it's not like we went in and said, okay, we are household finance researchers and we are thinking of Coco Gomez manhood and, no, but we said, okay, what risky portfolio share would you recommend for retirement saving? Okay, which is not a ridiculous, very unlikely question that somebody could have in mind. But that would be yet another sort of area of research to see, the sensitivity of the answers to the type of the prompt that you give, and how the type of the prompt links to financial literacy and education of the person issuing the prompt. And I think this whole idea of the link, also tomorrow's paper, the link between LLMs and models, and to what, to my mind also, to what extent can LLM adjust to your personal situation? So for instance, we know how difficult it is to build models with housing, right, compared to models without housing, which are still difficult, but how much more difficult it is. So the casual statement, I'm a renter, or I am a homeowner, I mean, that behind it has enormous computational consequences for optimal advice. And is the LLM actually coping with that, or is it just approximating with a Merton type solution and forgetting what you said about the house? I mean, these are also extremely important things to.
But I think adding to that, so you can talk to Camilla later, but we are currently in schools and we ask them what they want to learn. And one group of young people, the first question is, how do I get rich? I mean, this is how it starts, and then that's what I said before. What I find very interesting is then what the interaction will be, because if you sometimes it happens that dependent on the way you prompt, you get also critical questions back, right? So, but first, please tell me what blah blah blah. This is something which can come from the AI, right? So I wanna build a business, I wanna sell this and that, and then of course it could be that the AI asks you also questions reflecting on that idea, but it depends a lot on whether you will spend the time later on, and that's why I'm also very interested in when they will stop and whether they will take the unsolicited advice more or less also in this interaction.
May I ask a question? What is the competitive advantage of AI in these questions?
Compared to? Compared
to the best alternative, human beings. Because the competitive edge of AI is the processing huge amounts of data. And this is not the case of huge amounts of data. To give advice whether to invest 40, 60 or 70% in equity, that's not, for me, it's not a use case for AI. Interestingly, you can use AI for communication. Ask questions, answer questions, but the real edge of AI is to process huge amounts of unstructured, heterogeneous data. There's the value added. And therefore, I'm a little bit wondering why AI is brought into such a context.
Maybe because I think that the AI learns over time what kind of things people, for example, young people like at the age of 16 or 18 or 20 or 24, normally do not think about, but which is important. Mm-hmm. And if you talk to your parents, for example, your number of observations is 1 or 2, and they do not have this. They know you, they have their own perception, and they are influenced by their own perspective on that. And I think there comes also the financial inclusion potentially in play, that if your parents, for example, cannot help you with that, or your friends, that you can get a broader access to knowledge, in the sense of that children in your age or young adults in your age normally do not know this, and maybe proactively you get this unsolicited advice. That's what I was thinking of, potentially. But it could also go in the other direction.
Very good. So thank you very much for an extremely stimulating discussion, and also for your questions. So please join me. Thank you, panelists. The barbecue is not served outside, I assume very much, so it will be served downstairs. Probably the poor cook will have to prepare it outside. Yeah, we will meet downstairs, I think at 6 or 6:30? 6? So you're all, of course, invited. See you there. Thanks very much again for a very lively discussion.
Thank you.